Okay, let's take our start model, and just to give us some dummy data, let's just put in 100 for our 5 periods, okay? So that we can see that we've got 100 flowing through here. We've got net income of 100 in these 5 periods. And let's just say in these 5 periods, we receive 50 in the first period, and then we received 100 in every other period, and 150 in the last period. So total cash flow received is also 500, okay? But there's going to be a timing difference here. We're not distributing anything. We're not got any costs just now. We just want to get some dummy data, and then we'll just to see simply how this works. All right, let's go and grab a balanced corkscrew. If you don't know how balanced corkscrews work, go back and watch the section on how to model balances. And I'm going to take this balanced corkscrew onto my equity sheet, okay? And I'm going to drop it down here. And changing the labels, that's going to be my retained earnings balance. Okay, 0 starting balance. What is the upward flow? Well, that's going to be my profit after tax. And what is our downward flow? That's dividends. So what we said in our last section is retained earnings is the bucket that catches the profit that we don't distribute. So the upward flow is going to be profit flowing in. The downward flow is going to be distributions that we make in the form of dividends. Okay, let's do the same thing for cash. Back to the temp sheet, grab the corkscrew, drop it onto my equity sheet. And this time, instead of retained earnings, we're going to make this retained cash. Okay, and what's the upward flow? That's going to be my net cash flow in the period. And the downward flow, again, is going to be dividends. Okay, these are also placeholders. So let's go and grab our ingredients from our financial statements. Our net income, well, here I'm going to take my profit after tax number because we want the amount before the dividend is paid. So if I take that to my equity sheet, clear that out now, then we can see that that balance is building up, right? We've got 100, 200, 300, 405. That balance of retained earnings is building up because we're not making any distributions. Let's grab also our equivalent line from the cash flow statement, which is cash flow available for dividends. Okay, and we'll drop that into our cash balance. Okay, now this is also building up nicely. So let's go and drop these onto our balance sheet. Retained earnings, we said, was going to be on the liability side of the balance sheet, and our retained cash on the asset side of the balance sheet. Okay. Now, our balance sheet in this case doesn't balance, right? We are 50 out in every period. But what would actually be happening here, right, is that if we build 100 and only collected 50, we would have an accounts receivable balance of 50. So in this scenario, we would expect to have 50 in here. And under these numbers, that 50 is going to continue until this last period when we bill 100, receive 150, and so our accounts receivable balance would go to 0. So in that case, our balance sheet would balance again. Okay, so we can always see that whenever there's a difference in retained cash and retained earnings, there must be something else going on causing that timing difference. And that would be reflected on another balance somewhere else on the balance sheet. Okay, it's really useful to have this retained earnings and retained cash balance on the balance sheet from the beginning of the process, because it's much easier every time we add something in to see if our balance sheet balances or not. And that's the key kind of plumbing that keeps our financial statements connected. So for example, if I did have this kind of revenue and cash profile and I hadn't added the accounts receivable balance, then my balance sheet wouldn't balance. Similarly, if I'd added the revenue and I'd added the accounts receivable balance but didn't add the cash, then again, my balance sheet wouldn't balance. So what we can see there is that that's the kind of core plumbing that keeps our financial statements connected. And I'm just going to take out all these dummy numbers for now. Okay, so relatively straightforward. We've got a couple of placeholders here for dividends. We'll come on to that next. And we've also got a spot for initial balances. So in our case study, we're told that we're going to be investing in this wind farm just at the point when it goes into operations. It could be that there's been revenue and costs during the construction and development phase. That means there's some retained earnings and some cash balance on the balance sheet. So let's leave these there for now, and we'll circle back to those later.